Now, without further ado, I want to introduce our first guest speaker. Phil Kerpan is the Director of Policy for Americans for Prosperity, as well as a contributing editor for National Review Online, as well as a regular columnist for the New York Sun. Mr. Kerpan's columns run in newspapers across the country, and he's a frequent radio and television commentator on economic growth issues. He's also a publisher of CrossX.com, the leading website for high school policy debaters. Prior to joining AFP, Mr. Kerpan served as a policy director and acting executive director for the Free Enterprise Fund, an organization he founded with Stephen Moore in January of 2005. Mr. Kerpan has also previously worked as an analyst and researcher for Club Growth, the Woodhill Foundation, and the Cato Institute. So, Phil?
Okay. Thanks everyone for coming out. I'm really glad to be here in Illinois right now because this is, in my opinion, the biggest tax fight anywhere in the country. And a couple months ago, given how difficult the Michigan situation is, I didn't think another state could be in a worse tax battle, but that's where you are now because the governor's proposing here. So I'm going to talk a little bit about what the gross receipts tax is, why it would be so harmful, and talk about some numbers from other states that might give you more perspective on the tax. What is a gross receipts tax? It's a tax that's applied to the top line of a business. Every dollar that comes in the door is subject to the tax without respect to a company's cost, without respect to profits. Every dollar that comes into the door is subject to the tax. It is a gross receipts tax. And it's applied at every stage of production. So if a finished good goes through 4 or 5 different companies' hands before it reaches the end consumer, this tax will be applied every single step of the way, which can make the effective rate much higher than the statutory rate. So there's a big difference between other business taxes, which are typically taxes on corporate income or profits, and this tax, which is the tax on every dollar that comes in the door. That's important. The GRT is not a corporate income tax. As I explained, corporate income taxes are taxes on a company's profits, on its receipts, less its costs. This is not a corporate income tax. It's a much more harmful, much broader tax. It's not a sales tax, although it can often resemble a sales tax because we believe it'll be paid by the ultimate consumers, but it's not applied to final sales to consumers the way a sales tax is. Instead, it's applied at every stage of production, as I said. It's also not a source of easy revenue from big business, and this is what the governor is claiming. He's going on TV and saying, I think disingenuously, your taxes are high because corporations aren't paying enough. Now, the truth is, businesses only collect taxes. They don't pay them. Only human beings can pay taxes. And businesses have a few ways to pass those costs on to individuals. If they can't do so, they go out of business. There's simply no other place for money to come from to pay a tax other than from human beings. The biggest problem with this particular tax, which makes it significantly worse than a run-of-the-mill business tax, is the pyramiding problem. This is the problem where a tax is applied over and over again at different points in the production chain. Now, in Washington State, which is a state that has a gross receipts tax, the rate, they have a lot of different rates. Basically, every industry has a classification by code, and they have their own rate. It's a more complex system than what the governor's talking about. But the statutory rate averages about 0.5%, the same as in the governor's plan for manufacturing, significantly less than the 1.8% that the governor's proposing for everyone else. Now, in Washington in 2002, they had a special tax commission that did a study of what the actual incidence of this tax is for end consumers, what the tax costs. And they found that it varies by industry, but on average, the cost to final consumers is about 2.5 times the statutory rate of the tax. So for the 0.5% rate, it was about 1.5%. If that 2.5% relationship, if that 2.5 times relationship holds, for the 1.8% that Governor Blagojevich is proposing, that could amount to an average price increase of about 4.5% on top of the state's already high sales taxes as the price that's paid by final consumers. And that'll vary, of course, by industry depending on how many times a service or good is taxed in the production chain, but that's an average. Some would be a lot more, some might be a little less. But That's a very significant price increase to pass on to consumers. There's also a transparency problem with the tax. Good taxes should be transparent to the taxpayer. They should understand what they're paying so that they can make the political decision of whether they're receiving government that's worth what they're paying in taxes. This tax fails on that account. It fails on that account badly. In fact, there's actually a prohibition in the government's plan on businesses showing the cost of this tax to their customers. So if you operate a retail business, you can't show the cost of this tax on the receipt to the customer. It must be hidden. And this actually is, I think, why it's so attractive to the governor, is that he can extract enormous amounts of money from taxpayers in a way that's hidden from them. Not only with the initial tax, which could be 6 or 7 billion, estimates seem to keep going up and up, but increasing it in the future would be a lot easier because people wouldn't see the tax that they're paying the way they do with the sales tax, where they really get outraged when it goes up. So the lack of transparency is a big deal, and that's another big reason that this is a bad tax. The other big problem is the neutrality problem, and I alluded to this before, but every industry, based on the industry structure, would be affected differently by this, based on the number of times that the tax is applied in the production chain. Also, large vertically integrated firms, which don't have a lot of transactions because they can handle the initial resource extraction, the processing, the wholesale, the distribution in-house, have an enormous advantage over smaller companies where it's impossible for them to have an integrated supply chain. So it creates an incentive towards vertical integration that may be economically inefficient, and it disadvantages companies for whom that isn't an option. It also affects low-margin businesses much differently from businesses that have higher margins, because the tax is coming off the top. If you're in a competitive environment where there are very small margins, this tax can wipe you out. It can amount to your entire profit margin or more, and that's something that also treats every industry very differently, and that's a bad feature of a tax. These are some examples from Washington State, and these are a little different from when I was talking about the sales tax equivalent. What these numbers are is, these numbers are the equivalent rate that a corporate income tax would have to be to raise the same amount of money that the GRT did in each of these industries in Washington State. And what you'll notice is that the percentage of profits is, first, very considerable for a tax with a statutory rate of 0.5%. Second, it varies widely. These are just a few examples, but there's wide variation based on the profit margins that that industry has, as well as the extent to which the pyramiding affects that industry. And in some cases, such as groceries, that 0.5% tax ends up consuming 18.6% of corporate income. So it can be quite enormous in the impact that it has on corporate profits. And I'll remind you, the Washington tax is about 0.5%. The governor here is proposing 1.8%, so it would be more than 3 times as high. Now, tax-exempt food in Illinois would be exempt from this tax, but it's one of very few exemptions. So this should give you an idea of how high the effective rates can be as a percentage of corporate income. And that's certainly cause for concern, and with a 1.8% statutory rate, which he claims is low, but again, it's applied to the top line, you would see very considerable chunks of profits. And I'll also remind you that even companies that have no profits would be subject to this tax, which creates a real disincentive to entrepreneurial risk-taking, and companies that expect to run losses in the early years and often do have sales over $1 million where they would be subject to this. They're now paying a tax when they're out there risking their life savings on a dream in many cases, when they're not even profitable yet. And we think that's another very undesirable feature of this tax. Here's an example of what I was talking about with the differences in margins and how that can affect different businesses. This is a hypothetical that my friends at the Tax Foundation put together. It's a pretty simple stylized view, but if you look at a comparison of a high margin and a low margin industry that have the same amount of total sales, but have very different margins, if one has, say, a 5% margin and one has a 50% margin, which are perfectly possible given different industry structures that exist, you'll see that the difference in the incidence of the tax